We've got four gentlemen at the desks out the front here who are our panel, and I'll just quickly introduce them before I head into the content. So I'm the far right, closest to me, stage right, left for everyone, is Ben Flood, who's the CEO of Glass Financial. Next to him is John Clifford, who's a partner and sales manager at SpotCap Global. Next to John is Chris Sobolos, who's a partner here at Bartier Perry in our private clients team. And right up the end, furthest away from me, is Andrew Grant, who is the owner of Furnish and Finish, amongst other things. Now you'll learn a bit more about each of these gentlemen and also the businesses they're involved in as we go through this event. I've got a couple of dot points there just giving a bit of an indication about how lenders in this unsecured business market price effectively. So as with all these sorts of things, there's a consideration of the business and directors involved with the business and their credit history, looking at the principal amount that is going to be lent and pricing in a rate, a repayment rate. So it's likely that John and others at the table here will say a little bit more about that as we go through the event. So that's in general terms the broad market we're looking at tonight. More specifically, we want to explore what is happening in the fintech lending space, the online lending space. And as you can see from these dot points, there's about 2.2 million businesses that are classified as SMEs in Australia, employing about 7 million people. And that's better, thank you. And the vast majority of innovation in Australia comes out of that sector, okay? And this particular sector around unsecured business lending is no different. There's a lot of activity in this fintech lending space, and it's driving change. There's issues in the market around SMEs being starved, if you like, of capital, given tightening of credit from the banks and the traditional lenders. And the last dot point there is important. The RBA estimates that for small business loans of less than $500,000, there's an unmet market demand in excess of $20 billion. And it's that space that organisations such as SpotCap and others have looked at and are looking to exploit. And that's the area that we will predominantly be exploring tonight. So in the fintech market, I've just got a few points here, and I promise I won't go too much longer. But there has been a rapid advance in the fintech used in this space and generally in the finance sector since first launched not too many years ago. And you can see from the second point there, second from the left, that Deloitte have said that small businesses with advanced levels of digital engagement are 50% more likely to be profitable and earn on average 60% more per employee. And only about 1% of small business lending in Australia is carried out by online business lenders like SpotCap. And that just ties back into the point that the RBA was making in terms of the unmet demand. So a little bit more about the participants here tonight. So SpotCap Financial, as I've said, is a fintech lender. 130 employees and about 1,000 clients in Australia. 100 million raised globally since 2014. And features of SpotCap's type of lending: no security from the client. And when I say no security, that is in terms of registered mortgages and the like. You may have personal guarantees. And decision based essentially on the trading history of the business that's under consideration. What do they loan? Well, the way they structure things is a line of credit up to about $400,000, which converts into a loan upon drawdown. So they have terms of 1 to 24 months. Importantly, decisions made within a working day. They have a dedicated client service manager, and no early repayment fees. Now, John can tell you a little bit more about the business and other offerings and the market generally outside of SpotCap. Glass, as I've indicated, Ben Flood is the founder and CEO of Glass Financial. So Glass was set up a few years ago now, and it styles itself as an innovative finance brokerage combining traditional lending methods with new lending technology. So it sees as a point of difference in the financial space the use of fintech to differentiate. And you can see from Ben's background that he has worked in the banks, non-banks. He's worked in the sector for over 20 years, and he's well placed to be able to talk about how it is working in the bank, dealing with the bank, working outside the bank, and working with customers who want a better experience, and trying to find solutions for businesses as they move through their early stage growth and maturity cycles. So Glass provide residential lending or brokerage services, including self-managed super funds, debt consolidation, commercial and asset finance, and of course unsecured business lending as well. So their motto is transparency in lending, which really does, I think, tie in well with SpotCap's approach as well. Then Furnish and Finish, who are they and why are they here today? So Andrew Grant, at the end of the table there, is the owner of Furnish and Finish along with his wife Tegan. And as you can see there, it's an organisation that assists clients in property styling in New South Wales and Queensland for owners, agents, stylists, property developers. Primary objective to maximise the value of the sale. So they also provide interior decoration, long-term rental relocations and other things. In terms of tonight, it's pretty obvious that Andrew and Furnish and Finish are the client and central to the whole discussion that we're going to have here tonight. And then we also have Chris Sovolos at the table, who's a partner here at Bartier Perry, who works with private clients and businesses in terms of tax issues, personal structuring, business structuring, succession, both personal and business, asset protection. And that is all highly relevant in a discussion for businesses when you're dealing with unsecured lending. So at this point, that's a little bit about the market that we're talking about, drilling down a little bit into the specific area of fintech lending, online services, and who is on the panel. Now, I told you this is not a hypothetical tonight, and we are here to have a discussion off the back of a transaction. And I thought I might just throw to Adam Kutry, who's a senior associate in my team, the commercial disputes team, to just introduce from his perspective the players, I suppose, in the transaction, because he was the person who was instrumental in bringing these people together. So.
Thanks, Gavin. So I've been with Bartier Perry for about a year now, but prior to me being with Bartier Perry, Andrew Grant has been a long-standing client of mine for going on 7 years now. Andrew first came to me when his business was fairly immature. They were looking to expand up the east coast of Australia, and we worked through a number of challenges that we had. After I recently moved to Bartier Perry, Andrew came back to me and said, look, I've got some short-term finance issues. We have a quiet period being December through January. Is there anybody who you could put me in touch with so that I can seek to try and get some short-term finance in a different sort of field to which the banks were offering at that time? So after speaking with Andrew, I spoke with Gavin, who I work quite closely with, who has a direct relationship with Ben. And we had a bit of a chat about that, rang up Ben and said, Ben, look, I've got a client who might need some help in this type of area. Is this something that you can really help us with? And we immediately got on the phone to Ben, and Ben said, look, there's a number of different options, none of which I had previously heard of. Rang Andrew and said, Andrew, it looks like we might have found a deal for you. Why don't I put you in touch with Ben? Now, a little bit of background on Andrew. He's actually an ex-Macquarie Bank employee, so he knows about what's out there in the market, and that's what led to me putting Andrew in contact with Ben. Now, Ben, through his relationships, put him in contact with SpotCap, who has now done 2 deals for Furnish and Finish, and they're looking to do more deals throughout the coming years. So that's a little bit about the relationship and how that came about.
Okay, thanks, Adam. Well, to kick things off, what I'd like to do is throw to Andrew at this point. It's probably a logical place to start. So tell us a little bit about Furnish and Finish, how the big business has progressed, why it was Furnish and Finish got to a point where you believed it needed some finance, unsecured finance, and your thought processes there and how you went about, actioning that.
A lot of questions. Okay. Bit of history. We've been around 20 years, but there's probably two phases. There's probably the pre-2012 phase, which is, it would be unfair to say it was a sideline thing for us, but it probably was part of what my wife and I did to bring the income for the family. In 2012, towards the end of it, I left Macquarie. Primarily, part of the reason Macquarie was growing, my role was heading up to Singapore. We had a young daughter. So there was a kind of a bit of a push-pull thing going in the family. Do we go here? Do we stay with the business, etc.? We decided to stay in Sydney and stay with the business. At the end of the day, that was an easy decision for me. My wife had built it for 13 years or so. It had been a pretty good stage. But then suddenly it became the primary focus for our family. So we were kind of talking before that, that Furnish and Finish is still in a growth phase. For a 20-year business, you kind of go, really? But I guess there's two iterations of where we're at. There's kind of pre-2012 and there's, 2013 onwards. So we had, we took the view we needed to grow the business more. We were a lot more aggressive about it than we had been pre-2013. A lot of our growth all the way through until recently had been either organic or by our own funds, which wasn't too much of a problem. We were happy to reinvest the profits. It's a pretty safe way to do things. But where we were kind of, in the last year or so, the view was the business, we've probably had 5 really good years, actually. And so the business is now at a point where we thought it should stand on its own 2 feet. So our lender, our bank, who we had been with and still are to some degree with for 20 years, had kind of always, if we wanted to borrow money for the business, sure, if it was asset-backed, like if it was a warehouse or something, sure, there'd have to be security, of the asset. But in terms of things like, say an overdraft, that always wanted the business to kind of put funds in, so term deposit or to go over our mortgage or whatever. We didn't really think a lot of it at the time, but then kind of things have got to such a scale now where we're kind of like, no, you can't see us as one with the business. We need to be separate to the business in terms of lending. We need to do things with our own money. We've got our own goals as well. And so we spoke to the bank, and I think coming back to the need, so we have a very quiet period in December, and so Adam's right with that, but our view was and I guess I like certainty, we were looking at, I think when we started having these discussions was around August 2017, and I spoke to our bank and said, look, spring is a very busy period for us, December is not. We need to obviously have money put away to get through December, so we can pay our employees, etc. But we want to be able to bring on new clients. We want to preserve the existing agent referrers, if you like, that we currently have, but we want to bring on new clients through the spring period. That's a great time to do it. So, what can we borrow? Now, there's a service factor to this, which I could probably speak for 2 hours about at least, which I won't, but they took a long time to get back to me. And anyhow, by the time they got back to me, we're now kind of into spring. We've gone out, we've bought the furniture, we're growing the business, we've kind of done it. And they've come back and said, no, you've got to put your own money in. And then I've just gone, that's ridiculous. I said, what, even for 50 grand? And they're like, yeah, even for 50 grand. I'm just going, this is just crazy, So that's kind of what caused me to speak to Adam. I think I was talking about something else, but I said, mate, I've got this issue. You normally solve a lot of things for me. So if my wife can't solve it, I come to you. And so Adam put me in touch with Ben, and I can go on from there. I could probably hand over to you, Ben, to
maybe
kind of say.
Throw to Ben now, and Ben can tell us. So, what does the furnish and finish deal proposition look like from your perspective, and how do you deal with it?
I suppose we see a lot of clients that we deal with that come to us with a variety of different needs, and we've seen a big change in the credit markets, funding markets, and different appetites over the last 12, 18 months, and we've been worsened in the last 12 months. But so look, Andrew's proposition or position wasn't ideal, but I suppose it's all brought on by different requirements at different times within businesses. So for us, it was a fairly straightforward transaction to do, and we obviously did it very efficiently, and that's what any client is looking for in that position. And we've got a team that's worked, as you said before, in and out of banks for many, many years, and we've seen how much harder it's become to do lending in the mainstream markets. So having the capacity to use something like spot capping and sort of have a look at what does that short-term requirement look like, and what availability of facility, but also was it going to meet the client's needs. So in a few discussions with Andrew and having a look at short-term funding and what does it mean and how does it look for their business, it seemed like a good solution and was going to help him out immediately. So I think that's where we kicked it off with, and look, we've done some other work overall with Andrew and taking the short term as well. So it's been a good start to a great relationship, which what we look for with a lot of our clients. It's not a single transaction that we're looking to do. It is always, we'll start that and then look to morph into other things.
So we've seen the stats and what the ABS says about potential activity in this space. Is that on the ground at the coalface? Are you seeing more activity in the unsecured business lending space?
Certainly, and the opportunity growing. We've seen, I suppose, a huge amount of growth in the property market in the short term, and that's a lot of people think, well, we've got that security and safeguard there, but leveraging equity in your properties become harder. Banks now certainly don't like or want to be doing cash out on assets, especially if it's an owner-occupied property. So you've got to look further afield, and if there's no other assets to sort of lean on, that's when you've got to have a look at these alternative types of funding arrangements. And I think rather than sort of taking the longer view and saying, well, what if, these short-term funders that can provide that sort of immediate response, and it's not the cheapest solution in the market, and we don't promote that and make every client aware of that. But look, it is a good solution that can be fairly tax efficient and can meet that short-term need. But we need to also have a look at what else can we do to provide a longer-term solution.
So it's probably obviously more expensive than secured asset-backed lending.
It has to be when what is on the risk curve being unsecured. But look, there's still guarantees in place. The client's not getting away just by signing a document that says here's a certain amount of money and we'll leave you to it. It is certainly secured by way of a personal guarantee. But again, it's as we're moving more in towards the age of technology and the data analytics that we've got, not just through lending, but a lot of different sorts of industries now, leads into the availability of data and what they can actually do with it now. So a lot of big data companies that are making a lot of money out of what they can actually do with the data that's sort of grabbing from different sorts of industries now. And I think these guys in SpotCap have sort of identified that opportunity using the cloud technology that's coming out with accounting software, and how do we use that to leverage into the SME market. And I think it's smart business. Yeah,
so I want to hear a little bit about John about that issue of use of technology, software to analyse client circumstances, and how SpotCap may be doing that differently perhaps to the banks. Can we just park that for 1 second before we get on to that? We've heard that Andrew Furnish and Finish needed funds quickly. So how long, Ben, did the transaction take? From speaking to Andrew to getting 200k into, line of credit available, 200k available.
24 to 48 hours max.
Yeah, it was quick. It was really quick. And you guys got across the business so quickly, what the needs were. So I talked to Ben. Ben put me in contact with SpotCap, and the SpotCap guys were great as well. Again, just got to the crux of the issues very quickly. John, I'm sure you'll talk about this, but there's some system that they've got that goes through your cash flow and whatever and kind of works it out, boom, and then done.
Well, that's a nice segue, John. So why don't you tell us how it is that spot cap, assess, customers and decide to loan or lend?
Certainly. Okay, so a little bit about SpotCap. We're headquartered in Berlin. We're a global company. We have operations in the UK, the Netherlands, Australia and New Zealand. Founded in 2014. You've probably seen some statistics already on the screen there with regard to the kind of turnover, the kind of loan book that we've got now. We've recently reached a milestone of $250 million in lines of credit extended to small businesses, which is obviously a drop in the ocean compared to the majors, but it's pretty significant for a business like ours, where the average loan size is about $70,000. With regard to technology, I mean, we're part of a wave of fintech kind of cash flow unsecured lenders that have come to prominence over the last couple of years. There's about 6 of us. We're not the biggest, but our key selling point is that we're the lowest risk-based pricing in the market. As the name suggests, financial technology, we're obviously using advanced technology to assess businesses for their risk. And we feel that this is where we really kind of differ from the banks, where they might have outmoded kind of legacy encumbered processes. They've got credit committees. They have a traditional aversion to taking on risk. What we do is we've built our software up from the ground with really just very accurate assessment of the business's risk. Much like many other companies in a whole range of different software niches, like for example Google, Uber, etc., etc. What we're trying to do is amass enough data so that any business that comes to us, we can rapidly kind of assess it for the risk that it presents. So with regard to finish and furnish, or furnish and finish, I beg your pardon, and businesses like that, how we actually apply our technology. We have a brief online application made by the client where they'll give us their basic information, their time in operation, their turnover, how much they seek to borrow. We would require that the business is in operation for a minimum of 18 months and turning over $200,000. So we're not a startup lender. We're going to use the business's trading history as a way to predict what's likely to happen in it in the next 12 to 24 months. A brief online application. Then the client will securely connect their business bank account. Now this is probably a section, it's probably part of the process where people who are more familiar with traditional banking are a little bit hesitant perhaps. They may not have heard of SpotCap or one of our competitors in the past, and now they're being asked to securely connect their business bank account within our client portal. There's a whole movement for this kind of API across the world. There's going to be open banking from the middle of next year here in Australia. Canberra, Washington, London, Brussels, they're all pushing for the major financial institutions to free up the banking information that small businesses have to enable smaller players like ourselves to come in and provide more competition and more opportunities for businesses. So as I said, a brief online application, the client then securely connects their business bank account. We have our own in-house software that goes in and does a one-time data scrape. We do a keyword search within the client's bank account for various things like dishonor, reversal, etc., whether they're going to Crown Casino every weekend, these kind of things. But primarily what we're looking for is steady or forecastable cash flow that we can see over the year, taking into account that in certain businesses there will be seasonality, and then making a really solid prediction as to the next 12 months. For a loan of less than $100,000, that's essentially all that we require. The secure bank account connection will give us enough data to make a really informed decision. We ask the client to self-report their current utilization of overdrafts and credit cards, recent profitability in the business and whether there's any ATO debt. And then once we have all that information, we should have a decision in 1 working day. In terms of using technology for loans of greater than $100,000, we would also ask the client to give us recent financials. So increasingly we would look for clients to integrate their Xero, Intuit, MyUp, whatever accounting software that they use. It's becoming more and more commonplace. If they do that, then the whole process is very, very quick and painless. If they don't, it's still painless, but we would ask for 4 quarters of BAS and P&L and balance sheet for the last 2 years, just so that we can get a really clear idea for those bigger loans as to the business's current kind of standing.
And when do the personal guarantees come in? At any level, or?
Yeah, no, personal guarantees, about 95% of the deals that we do will require personal guarantee. So if it's a really small, maybe less than $20,000, and the business is very well established, then we may not ask for it, but it is asked almost universally. We'll ask for personal guarantee. Again, completed online using DocuSign. We do realise that as an unsecured lender, this probably doesn't really amount to much of a security. We know that we're the last in line with our hand out in the event that the business doesn't succeed. So we really back ourselves with our credit scoring algorithm to get a really clear idea of the business's risk before we lend to it.
So I wanted to ask Chris a question off the back of that, because as a litigator and a commercial disputes lawyer, lending up to $400,000 with no security and maybe a personal guarantee doesn't sound like a great idea from my perspective. But obviously there's a business model that begs to differ. What do you say about that, Chris?
Yeah, the way I was going to look at it is I'm Gav's hypothetical in today's discussion. So I'm sort of the opposite to these guys. It's a good news story. But sometimes we get brought in on the basis of when a client's looking for short-term funding, usually they do have some real financial cash flow issues. And we're often brought in and saying, can we structure our affairs so if this short-term funding becomes a real long-term funding problem and we find we're defaulting at various places, what can we do? Now, the age-old thing is you can only deal with what we start off with. So in the perfect world, when a client does asset protection, they structure from day one. It's putting in place the right structure a number of years ago, but not only having the right structure, it's also controlling cash flows as well. For example, we say to clients is, and this is always an interesting one for the people that have partners out there, is have separate bank accounts between yourself and your partner. That way you can trace where each person's money goes and which part of the loan or the house loan's paid by which partner. So you can actually differentiate those interests. But the other thing, for example, is we had a situation a number of months ago. We had a client had a cash flow concern. He was getting closer to issues. So we looked at the business structure. There wasn't much in there because if he did go under, then the first tier secured creditors would take a lot. What was left over, the unsecured creditors would take, and then it was literally going through the personal assets. So his biggest concern was his family home at the time, which is people's often biggest concern. He and his wife owned the house as joint tenants, which is quite standard. So they own the house joint tenants, and if one passes away, the other automatically survives. So we could only tinker a bit with it. So what we looked at were things along the lines of, first thing, separating from joint tenants to tenants in common. Heaven forbid his wife should predecease him during this period and he automatically inherits her 1/2 interest in the house and puts that at risk. Also, we asked him and his wife to look long and hard, have they ever received any money from their parents or friends or close relatives, and was it truly a loan or was it actually truly a gift? And are they getting concerned about their current financial issues? And if they are, would they like to take some kind of security? So look through those bank accounts 5 years ago, 6 years ago. And who was the loan to? Was it to the husband who was in business, or was it to the wife? Oh, it was all to the husband. Great. And then they obviously let their, in that case it was their father-in-law, know about the incoming issues. The father-in-law said, well, I really do want to get that loan agreement in place. They severed the tenancy from joint tenants to tenants in common, which doesn't create a gift but makes it safe from the perspective of securing separate assets. So then the husband secured his half, 50% tenants in common interest, with a loan that was outstanding from his father, which father-in-law, which you could find bank accounts going back a number of years. And you could actually then document it through and bring it up in case something went wrong. It's all, my description is often speed humps. It may or may not be successful depending on who comes after you and how much they want to go after you. But it actually starts creating a position from being entirely defensive to potentially have a position to end up in a better result. So that's our hypothetical.
Okay, thank you, Chris. That's very helpful to give us an insight as to what you think about in these sorts of situations. Andrew, I wanted to throw back to you. So you're ex-Macquarie Bank. You've dealt with the big banks. You've told us that. How did you feel dealing with SpotCap as an online, small online fintech type lender? How did you find the experience? And can you compare the experience to dealing with a bank?
Yep. Let's start with the easy first. The easy stuff first. In terms of dealing with them, very good, very quick, very efficient. The process itself was painless. So compared to, actually might park my relationship with the bank just for one sec. No, but it's an important point to discuss. But just quickly, comfort with SpotCap in terms of online lender, giving your information, access to online banking, all that kind of stuff, Xero. Look, I was introduced to them by Ben, who Adam introduced me to. Ben and I had built a relationship. So from that perspective, I got a lot of comfort. Would I have been concerned if I'd just gone in directly? I'm not sure. I don't think so. I think at the end of the day, the commercial need would have outstripped my concerns, I think. I mean, what's there to lose? They would have been coming in, looking at my banking. So what? It's nothing exciting. It's pretty boring. It's not my personal bank account. So that's all fine. So they would have gone through that. They would have gone through Xero. There's not too much of a concern. Personal guarantee doesn't scare me. Every landlord I have, like in Sydney and Brisbane, has one of those. So for our warehouses, etc. So that's not that's nothing unusual. So no, look, I think overall the commercial need of needing that money quickly, it's facilitating growth. Essentially, I mean, put the seasonal aspects aside. It's about growth. It's about going into. It's about saying during a season we want to grow, we want to spend money, and then we've gone back again this year again to buy more stock. And that enables us to do more business because we can do more properties each week, each month, etc. Brisbane is a relatively new area for us. We've only been there maybe 2 years. That's growing probably more quickly than Sydney. So you need it. So yeah, I didn't see the concerns really. Compared to dealing with our bank, who we had a relationship with 20 years, like for 20 years. Look, the issues there are, I think, credit, their internal credit, getting across, understanding our business, understanding what's profit, what's add back, all those kind of things. So trying to really understand the business. These guys got it really quickly. Maybe that was helped by Ben, but whatever. But that model really worked. But the other thing as well, in terms of service, my business relationship personal, whatever they're called, I've had probably 6 of those in the last 2 years, maybe. Not very experienced, which I kind of get. We're not the world's biggest business, so I don't expect someone that knows everything. But dealing with a smaller player, with obviously people who are more experienced, a bit more skin in the game, a bit more senior, whatever, fully across what they're offering, much better outcome. Just a much better outcome.
Okay.
Pushing the proverbial uphill with certainly my bank.
Yeah, okay. So Ben, just it's a good segue to you. Is that your experience in terms of looking at different options for your clients and looking at the banks and non-bank lenders?
Yeah, look, so we have a very large panel of lenders that we deal with, and look, again, these are not uncommon situations that we're dealing with now, but the big thing, I think, and a couple of disclaimers here, we deal with Andrew's business. For the accountants in the room that sort of go, well, invoice discounting may have been a better solution. Because Andrew's business is B2C, not B2B, we can't invoice discount, so there's not that capability. So it kind of limits some of the other possibilities that different businesses may have. Because we certainly look at things like cash flow funding in its general sense, so invoice discount, but not having the capacity to do that, having a business that was trading very comfortably, we'd seen the revenue just continue to grow, so we're concerned about putting this type of lend together for Andrew's business. And look, and these guys, Spotcap certainly don't approve every facility. I've certainly taken other clients to them that they've gone through the position and said, look, not the right timing, or look, we can't see that they're profitable enough to get the outcome that they're looking for. So we have had situations where we've had to look at something different, and invariably that happens in any type of lending. But look, knowing sort of where Andrew's growth is sort of heading and what his plans are for the business, and they're very robust. So look, we were very comfortable knowing that there's other ways that we can also position him to get that repaid as well.
So talk a little bit about, well, quite a lot about the fintech used in this space. Presumably the banks, with the market cap they have and everything else, would be investing in fintech. So
No.
are there... Well, I mean, what I'm interested in is, are you seeing structural impediments to the banks being able to deal with opportunities like the furnish and finish opportunity in the way that, say, SpotCap did, or some other reason?
We just don't have the capacity to trade in it. It's again, it's one of the guys touched on. They're not happy with the risk associated with it, so they want full security. And your typical bank mentality is to tie the clients up in as many knots as you can, so they can't go anywhere. And I think those days are over. That's why we're seeing these types of products come to market. But you know, the Royal Commission has only really given us one opportunity, which is to engage and educate clients on what they should be doing is looking past the four major banks. They've had too much control for far too long, and we're going to see that shift. And I think we already are seeing that with the growth in the secondary market already. And the guys like your INGs that have been the sleeping giants and Macquarie's, these sort of guys that have been there for a long time, are really starting to make noise and actually will benefit largely from this. And we're seeing other clients that would have traditionally said, I'm blinking towards the bank now, saying, well, what else is actually out there? I'm actually not too concerned now. We've come out of the GFC, by and large. There's still a little bit of it lingering, but overall, a lot more open and receptive to different opportunities.
Right. So you're seeing a shift in the people, customers you're dealing with.
There has to be, otherwise we'll stay stagnant.
Yeah,
so.
okay. And you're seeing a movement away from the banks because of the tightened
definitely.
credit and after the Royal Commission. Okay. So John, I mentioned earlier when we were looking at one of the earlier slides, the code of conduct, that SpotCap and 5 other of the online fintech lenders have signed up to. I'm not going to bore you by putting it up, but I might just let John explain what the code of conduct is, why it was considered to be necessary and important. There's probably a marketing element to that as well, I suppose. I'm not sure, but we'll hear. So.
Absolutely. So look, there is a bit of perception that the type of lending that we do is kind of unregulated, and it's probably well founded. We're carved out of the NCCP, so we're not actually subject to the licensing that ASIC would normally apply to a lot of lenders. From our own perspective, because we're a global operation with operations in the UK, we've kind of taken on board what the FCA has applied to them over there. We've kind of adopted that as part of our global best practice, as a way to kind of run our business. In terms of the way that the business the lending landscape has evolved for unsecured small business lenders in Australia, some of our competitors will charge what's known as a factoring rate of, we'll say, between 1.2 and 1.4. Others will have a total cost of interest. Some will, actually nobody quotes an APR. So what we were looking to do, the Ombudsman, Kate Carnell, was, I suppose, seeking to, tell us to get our house in order before it was kind of imposed upon us. So we, along with the 5 other biggest lenders in the space, a couple of months ago, came up with the Lending Code of Practice, which basically is seeking to harmonise the way that we price our product, so that any client who approaches any one of us will see a pretty standard document that outlines the total cost of the product that they're about to take on. That's probably a good opportunity for me to talk about cost. So it's been great to have Andrew here as an advocate for our particular product here, and the way he tells it certainly is very useful for his business, and it's been very gratifying to hear him talk about it. But obviously, one of the downsides of our particular type of lending is cost. Obviously, for most people looking to get secured lending, they might be looking at between 5 and 8%. With us, for a typical $100,000 loan repaid over 12 months, the client might expect to pay about $112,000. So it's not going to be cheap compared to secured lending, but for unsecured, we believe it'll be the lowest price in the market. Again, talking about the competitors who use a factoring rate, for a similar $100,000 loan with a factoring rate of between 1.2 and 1.4, cost of funds is about $120,000 to $140,000 over 12 months. So not cheap finance. I mean, if you approach a lot of small business people and you tell them, I'm going to give you $100,000 now and it's going to cost you $130,000, can you realise more economic benefit if I give you that funding now? Most of them will bite your arm off and say, absolutely, we can. But I think probably what we have been looking to do in a somewhat unregulated space is just to get all of the big lenders together and get everybody to, I suppose, present the product in a really clear way so that people compare like and like when they approach one of the various different lenders in the space.
Okay, thank you. We have been talking amongst ourselves effectively for a while now. I thought I would throw it open to the floor to see if there are any questions from any of our audience members at this point. If anyone wants to... Adam's got a mic there, so... No, I won't call anyone out. Oh, there we are. Can we just wait for the microphone so we can, just to record the...
You mentioned that you can go online and fill in forms about your business. I personally would have clients that would be really uncomfortable with that. Do you also go see them, or can they come see you at an office? Or do you find that's how you want to initiate a relationship, is online?
Yeah. Look, we are a fintech, so I mean, as the name would suggest, we are looking to make the process as automated as possible and have all of the application completed online. So a key selling point of our product is no paperwork, no wet signatures, everything done. I mean, the application process can take as little as 5 minutes for a client. If you do have, I mean, speaking for myself, if you have a client who's based locally here in Sydney or even interstate, who would very much appreciate a kind of in-person visit, it's something I'm happy to discuss and potentially do. But the application process will certainly be all done online. It's kind of the way that this particular type of lending operates.
And do you see, Ben, do you see your role as a broker changing because of, if there are more online, fintech style lenders?
Yeah, well, even looking at just this transaction, I suppose if you're looking at how it's actually done by way of the process, so we actually collect a lot of the data and actually perform a lot of that for the customer anyway. So they're not actually having to do a lot of the heavy lifting with the transaction. So it would be us actually collecting it, putting it all in, and then it's just a simple review by the customer before it's then submitted.
So I suppose in terms of initiating the relationship, as the question was, you may not be initiating a brand new relationship because if you go through a broker, then obviously the relationship's already established as between the lender and the broker. So half the work's done.
Yeah, look, I think a lot more clients that we're dealing with sort of want that support structure, and talking to clients about how they're actually going to go and transact with the bank, and it's sort of mind-blowing to hear some of the responses. The thought of going in and dealing with the bank directly, or having to deal with a provider they haven't dealt with before, and that's again where we come in and actually provide that structure and support, and knowing the different sorts of programs and different sorts of opportunities in the market, and we can actually weave them through that maze. So.
Okay. And John, ideal client for a spot cap, is there one?
Well, look, I started with the business at the beginning of 2017, and I'm based in Sydney, but I service nationally. I'm involved in kind of channel sales, so I will speak to brokers, accountants, financial advisors, the likes of Ben, and then they will present my product as a solution to their clients. In that time, I have had brokers approve deals for mining in Western Australia, manufacturing in Victoria, agriculture in Queensland, and all of the above in New South Wales. So we run the gamut. There's no business that we won't consider, so long as they meet our minimum criteria of 18 months in operation and turnover of $200,000. Having said that, I mean, what we're really looking for is businesses that are about to embark on a growth trajectory, or kind of already in the midst of it, who possibly are outgrowing their balance sheet. I mean, most small businesses will go through cash flow squeezes at a particular time. That's why it's especially good to work with accountants who are normally able to anticipate these kind of things, and we can have the finance in place for the client before that particular need becomes very pressing and it becomes more difficult to actually lend to the business. So yeah, I mean, so long as they meet our minimum criteria and they're well run, manageable liabilities, ATO debt isn't creeping up. If the ATO, like, we're realistic about ATO debt. I mean, by most estimates, the ATO is the biggest small business lender in Australia, so we're realistic about that. So long as the business is being practical and realistic about it, we're happy to lend. Probably not to take out ATO debt unless there's probably about 2 scenarios where it makes sense, which I'll quickly jump into. It's if the client has maybe been given 6 months to repay a particular ATO debt, and they prefer to have 12, 18, or potentially 24-month schedule, which they could take with us. Or if the client is looking to get a larger piece of finance with a larger lender, and that is contingent on a clear ATO portal, then that's probably a reason to use it. But yeah, essentially if the business is profitable or clearly moving towards profitability, manageable liabilities, minimal ATO debt and meets our minimum criteria of time and operation and turnover, we're happy to lend.
Okay. Yep. Philip?
John, again, just to suggest, so you're a German-based company, where do you raise your fund? Private
Sorry,
company,
Philip.
I presume?
Could we just...
Yeah, just a question for John. So you're a private German company. As a matter of interest, where do you raise your funding from?
Yep. So initially backed by European private equity, an organisation called Finstar, which is a bit of a tech lender incubator. Since then, last year we took a round of funding from Heartland Bank in New Zealand. We're staying pretty autonomous here in Australia. There have been overtures and there's been discussions with kind of larger kind of financiers in Australia, but we're looking to kind of keep our own, to stay independent, I suppose. We finance our local book and our local operations locally.
Okay, any other questions at this point? Do you anticipate, John, increased regulation?
Yes, I think probably eventually it will occur, but I think that the steps that we've taken in recent times to just, I suppose, clear up a little bit of ambiguity with regard to pricing and I suppose harmonise the way that we and our competitors present the product to clients it'll probably remove the immediate urgency for that particular type of legislation.
Okay. Any questions at all? Because we're through the content I think that I wanted to get through anyway. Is there anything any panel members wanted to say just in conclusion or summing up from their different perspectives? No? Okay, well we might wrap things up there and we can continue the discussion over drinks and, thank you, and eats. Before everyone goes, I do have some formalities to do. I have some gifts for our panel members, so if we can thank them in the usual way.
That's very kind. Thank you.
And we will be having another session, which is sort of a part 2, I suppose, probably early next year. We'll be looking at forms of longer term, medium to long term funding and looking at some credit and debt issues around that as well. So thank you for your attendance tonight and look forward to saying hello over a drink.